Hello students, welcome to EPG Pathshala. I am Dr. Mandeep Kaur from Guru Nanak Dev University, Amritsar. Today we are going to talk on the module Convertibility of Rupee from the paper Business Environment. Students, we are going to learn in this module and will be able to know what is actual meaning of convertibility of rupee, and will understand what is current account convertibility, also what is capital account convertibility, and will be able to differentiate and calculate that what is current and what is capital account convertibility. In India, some decades back, the exchange rate was controlled by RBI, that is our Central Bank, Reserve Bank of India, for conversion of Indian currency into foreign exchange. By virtue of this control, all the foreign exchange earned was to be sold to the authorized dealer, and if we want to purchase a foreign exchange, we have to seek the permission of again the apex central bank, that is RBI. The main purpose behind this was to utilize a foreign exchange earned by the residents as per the priorities fixed by the government. These controls were necessary at that time because at that time India was an underdeveloped country and its exports were limited to only agriculture products or raw materials, and it used to import only consumable goods. But now the time has changed. India is a fast developing country and one of the most preferred countries for the investment by the foreigners. So India could not restrict its foreign trade as it need to grow further. Thus, the government allowed convertibility of rupee in the phased manner on current account transactions. But full convertibility of currency for capital account transaction is still a distant dream.
Let's talk about the meaning of convertibility of currency. Convertibility of currency means when the currency of a country can be freely converted into foreign exchange at market determined rate of exchange. That is, exchange rate is determined by the demand for and supply of the currency. For example, convertibility of rupee means that those who have foreign exchange, for example US dollars or pound or sterlings, etc., can get them converted into rupees and vice versa at the market determined rate of exchange. Rupee is both convertible on capital as well as current account. Now, what is this current account and capital account? Current account means all exports and imports of merchandise and invisible like services, etc. By capital account convertibility, we mean that in respect of capital flows, that is the flows of portfolio capital, direct investment flows, flows of borrowed funds and dividends and interest payable on them, a currency is freely convertible into foreign exchange and vice versa, again at market determined exchange rates.
Now, what is this current account convertibility of rupee? Current account convertibility means when the foreign exchange, may be pound sterling, US dollar, etc., received for export of merchandise and services can be freely converted into Indian rupees and vice versa in case of imports. In the 70s and 80s, many countries switched over to the free convertibility of their currencies in foreign exchange. So by 1990, 70 countries of the world had introduced currency convertibility on current account, and another 10 countries joined them in 1991. So as a part of new economic reforms initiated in 1991, India also joined this regime and made rupee partly convertible from March 1992 under the scheme Liberalized Exchange Rate Management Scheme.
In this scheme, 60% of all receipts on current account, that is the merchandise exports and invisible receipts, could be converted freely into rupees at market determined exchange rate quoted by the authorized dealers. while 40% of them were to be surrendered to RBI, that is Reserve Bank of India, at the officially fixed exchange rate. This 40% exchange receipt on current account was meant for meeting government needs for foreign exchange and for financing imports of essential commodities. As even after partial convertibility of the rupee, foreign exchange value of the rupee remained stable. So this laid down a base for the full convertibility on current account. Hence, from March 1993, rupee was made convertible for all the trade in merchandise. In March 1994, even the invisibles and remittances from abroad were allowed to be freely convertible into rupees at market exchange rates, but this does not mean that one can get any amount of foreign exchange for meeting one's needs. For example, one cannot convert his savings in the country for investment in foreign exchange, as could be done by the citizens of developed countries like UK, USA, etc. However, on capital account, rupee remained non-convertible. Let's talk about the advantages of currency convertibility. The first one is encouragement to exports. Market rate remains generally higher than the officially determined exchange rate. This implies that from given exports, exporter can get more rupee against foreign exchange. This will help to increase the exports. It also leads to encouragement in import substitution. Imports become expensive due to convertibility of rupee. Thus, it discourages imports and boosts import substitution. Thirdly, it is an incentive to remittances from abroad. Earlier, NRIs used to send money illegally to India, like hawala money, gold, etc. But due to removal of restrictions, NRIs can easily remit money to India. It will help to improve the balance of payment position of India. Reduction in malpractices. Malpractices like under-invoicing of exports may not arise as a fully convertible rupee is there, and they will get full value of their exports. A self-balancing mechanism. Another important advantage of currency convertibility lies in its self-balancing mechanism. When balance of payments is in deficit due to overvalued exchange rate under currency convertibility, the currency of the country depreciates, which gives boost to the exports, lowering their prices on the one hand and discouraging the imports by raising their prices on the other hand. In this way, deficit in balance of payment gets automatically corrected without any intervention by the government or the central bank. The opposite happens when the balance of payment is in surplus due to the undervalued exchange rate. Capital account convertibility of rupee. This capital account convertibility, that is CAC, is a freedom to convert local financial assets into foreign financial assets at the market determined exchange rates. It's referred to as capital asset liberation in the foreign countries. It basically implies the free exchangeability of currency at low rates and an unrestricted mobility of capital. India at present has partial capital account convertibility. In India, there are conflicting views as far as full convertibility of capital account is concerned. At present, there are no limits on investment by foreign financial investors and also caps on FDI ceilings in most sectors. For example, 74% in the banking and communication, 49% in. Now let's talk about advantages of capital account convertibility. The first one is unrestricted mobility of capital. Capital account convertibility allows free mobility of capital into the country from the foreign investors. It allows converting the foreign exchange brought into as capital to convert into rupees at market determined rates, which makes the investors encouraging. It allows the foreign investors to easily move in and move out from the economy. Thus, enables the domestic companies to raise the funds from abroad. Secondly, ability to invest in abroad easily. Capital account convertibility allows the individuals of the nation to invest in abroad by easily converting their rupees into foreign exchange at the rates determined by the market. This enables those potential domestic investors to acquire and own the assets in abroad. It leads to improved access to the global financial market. That is, one can easily invest in equity and debt markets of another economy along with the reduction in the cost of capital. Now, coming to disadvantages of this capital account convertibility. First one is easier access to Hawala money. As it allows to convert any foreign receipt into Indian rupees at market determined rates, there may be the chance that the domestic economy will be flooded with foreign exchange, which in no longer run may damage the financial health of the economy. Secondly, high volatility of markets. During the times when the financial markets of the economy are doing very good, a country may receive huge foreign investment. But during the adverse times, the reverse scenario may happen. For example, when the Federal Reserve Bank of America gave a sign that they are going to increase the interest rates, the foreign institutional investors who invested their dollars in the Indian stock market had withdrawn their investment from India, which adversely impacted the value of rupee.
Now, the Tarapore Committee on Capital Account Convertibility was set up. It was a committee on capital account convertibility which was set up by Reserve Bank of India under the chairmanship of former RBI Deputy Governor Mr. S.S. Tarapore. That's why the name of the committee is Tarapore Committee, with objective to lay the roadmap to capital account convertibility. So in the year 1997, the Tarapore Committee had indicated the preconditions for capital account convertibility. The three crucial preconditions were fiscal consolidation, a mandated inflation target, and strengthening of the financial system. So the five-member committee has recommended a 3-year time frame for complete convertibility by the year 1999-2000. The highlights of the report of this committee, including the preconditions to be achieved for the full float of money, were like: first one, gross fiscal deficit to GDP ratio has to come down from the budgeted 4.5% in 97-98 to 3.5% in the year 1999-2000. Moreover, a consolidated sinking fund has to be set up in order to meet the government's debt repayment needs, to be financed by increasing in RBI's profit transfer to the government and disinvestment proceeds. Moreover, it was decided that the inflation rate should remain between an average 3 to 5% for the 3-year time period, that is from 1997 to year 2000. Then the gross NPAs of the public sector banking system needs to be brought down from 13.7% to 5% by year 2000. So at the same time, average effective CRR needs to be brought down from the current 9.3% to 3%. RBI should have a monitoring exchange rate band of plus minus 5% around a neutral real effective exchange rate. RBI should be transparent about the changes in rear. Even the external sector policies should be designed to increase the current receipts to GDP ratio and bring down the debt servicing ratio from 25% to 20%. 4 indicators should be used for evaluating adequacy of foreign exchange reserves in order to safeguard against any contingency. Plus, a minimum net foreign asset to currency ratio of 40% should be prescribed by law in the RBI Act. Apart from these essential preconditions, this committee, that is Tarapore committee, also recommended that RBI should have a monitoring exchange rate band of 5% around real effective exchange rate, that is REER, and should also intervene only when this REER is outside the band. Secondly, the size of the current account deficit should be within manageable limits, and the debt service ratio should be gradually reduced from 25% to 20% of the export earnings. Moreover, in order to meet the import and debt service payments, forex reserve should be adequate and should range between $22 billion to $32 billion. And the government should remove all the restrictions on the movement of gold. The second Tarapore Committee on Capital Account Convertibility. Reserve Bank of India appointed the second Tarapore Committee to set out the framework for full capital account convertibility. The committee was established by RBI in consultation with the government to revisit the subject of full capital account convertibility in the context of the progress in economic reforms, the stability of external and financial sectors, accelerated growth, and global integration. The report of this committee was made public by RBI on 1st of September 2006, which had drawn a roadmap for 2011 as a target date for full capital convertibility of rupee. In this report, the committee suggested 3 phases of adopting full convertibility of rupee in capital market. The first phase was in 2006-7, second in 2007-9, and third by 2011. Following are some of the important recommendations of this committee. The first of all, the ceiling for external commercial borrowings, that is ECBs, should be raised for automatic approval. NRIs should be allowed to invest in capital markets. NRI deposits should be given tax benefits. Improvement in banking regulation. FII, that is foreign institutional investors, should be prohibited from investing fresh money raised to participatory NOBs. Existing PN holders should be given an exit route to phase out completely the PN notes. The full convertibility, that is a capital convertibility of rupee, seemed to be desirable at the end of 2006 when the committee submitted its report. However, economic events, especially global financial crisis of 2007-9, brought about a sea change in the economic situation. It was evident that countries with full capital account convertibility were most affected. The Indian economy would have been greatly affected by the global financial crisis if we had implemented the recommendations of the Tarapore Committee. We could not have coped up with the extent of capital outflows that took place during the year 2008 and 9. Present status of capital account liberalisation. Government of India has revised rules pertaining to FEMA, that is foreign and capital account transactions during different periods of time. In context of large capital flows and the upshots of previous modifications during the last few years, Government of India and Reserve Bank of India have recently done some additional amendments. The revisions related to capital account are as far as the authorized dealers are concerned, RBI has provided license to the entities for dealing in foreign exchange. 3 categories are there. Number 1, authorized dealers category 1, which includes public, private and foreign banks. Authorized dealers category 2, which includes authorized on city basis, that is cooperative banks, private forex dealers and travel agents. Then authorized dealers category 3, including non-banking finance corporations. The authority vested in the hands of AD1 is the largest, that is ranging from stock market transactions to NRE accounts, ECBs, ADRs, etc., while the other categories of ADs have limited role to play. If we talk about FDI, that is foreign direct investment,
It is restricted to some of the factors, that is multi-brand retailing, lottery, gambling, betting, casino, chit funds and nidhi companies, trading in transferable development rights in real estate business or construction of farmhouses, manufacturing of cigars, cigarillos and cigarettes of tobacco or tobacco substitutes, atomic energy and railway transport. In rest, all the sectors like agriculture, mining, manufacturing, print media, broadcasting, aviation, courier service, telecom, insurance, construction, banking, etc., the limits of FDI range from 26% to 100%. All the foreign operators have to abide by the sectoral restrictions of the statutory regulations in addition to FDI rules. As far as ADR and GDR by Indian companies are concerned, Indian companies can raise additional finances abroad through the issue of ADRs and GDRs in accordance with the guidelines issued by Government of India. Unlisted companies which have not so far assessed a ADR and GDR route for raising funds in the global market would require prior listing in the domestic market. Unlisted companies which have already issued ADRs and GDRs in the international market have to list in the domestic market on making profit or within 3 years of such issue of ADR GDRs, whichever is earlier. A limited two-way fungibility scheme is also operationalized through the custodians of securities and stockbrokers under SEBI. ECBs, that is external commercial borrowings, and FCCBs, that is foreign currency convertible bonds. The ECB limit under the automatic route is enhanced to US $750 million as per circular dated September 23, 2011. The maturity guidelines have also been revised according to the circular given on January 5, 2012. ECBs up to $20 million in a financial year should have a minimum average maturity of 3 years. ECBs of more than $20 million and up to $750 million or equivalent should have a minimum average maturity of 5 years. Eligible borrowers under the automatic route can raise foreign currency convertible bonds up to US $750 million or equivalent per financial year for permissible end uses. Even the corporates and services like hotel, hospital and software can raise FCCBs, that is foreign currency convertible bonds, up to US $200 million or equivalent for permissible end uses during a financial, but the proceeds of the ECB should not be used for acquisition of land. Even the ECBs or FCCBs availed of for the purpose of refinancing the existing outstanding FCCBs should be viewed as part of the limit of US $750 million available under the automatic route. If we talk about government securities, NRIs and SEBI registered FIIs, that is foreign institutional investors, are permitted to purchase government securities or treasury bills and corporate debt. The details are that on repatriation basis, a non-resident Indian can purchase without limit dated government securities other than bearer securities or treasury bills or units of domestic mutual funds, bonds issued by the public sector undertakings in India, shares in public sector undertakings being de-invested by Government of India. On a non-repatriation basis, dated government securities other than bearer securities or treasury bills or units of domestic mutual funds, units of money market mutual funds in India, national or saving certificates. A SEBI registered FII may purchase on repatriation basis dated government securities or treasury bills, listed non-convertible debentures or bonds issued by an Indian company and units of domestic mutual funds either directly from the issuer of such securities or through a registered stockbroker on the recognized stock exchange in India. Even the FII investment in government securities and corporate debt is subject to the investment limit. For the FIIs in government securities currently is US $10 billion and limit in corporate debt is US $20 billion. As far as joint venture or wholly owned subsidiary abroad is concerned, an Indian party is allowed to disinvest without prior approval of RBI, subject to the satisfaction of certain conditions. That is, the joint venture or wholly owned subsidiary are listed in the overseas stock exchange. The Indian party is listed on a stock exchange in India and is having a net worth of 1000 million Indian rupees, and investment in joint ventures outside India is not exceeding 10 million US dollars. The Indian party is an unlisted company and its investment in joint venture outside India does not exceed 10 million US dollars. Moreover, the Indian party does not have any outstanding dues by way of dividend or technical know-how fees or royalty, consultancy, commission or other entitlements and or export proceeds from the joint venture or wholly owned subsidiary. Joint venture or wholly owned subsidiary has been in operation for at least 1 full year and the annual performance report together with the audited accounts for that year has been submitted to RBI. Another condition is that the Indian party is not under investigation by Central Bureau of Investigation, that is CBI, or Directorate of Enforcement or Security and Exchange Board of India or Insurance Regulatory and Development Authority or any other regular authority in India. An Indian party which does not satisfy the conditions stated above for undertaking any disinvestment in its joint venture or a wholly owned subsidiary abroad shall have to apply to RBI for permission. As far as FII, that is foreign institutional investment, is concerned, non-resident Indians, persons of Indian origin, are allowed to make direct investment in Indian companies under the automatic route of FII, NRI, PIO and HNIs, subject to the following: that securities in the primary and secondary markets, including shares, debentures and warrants of the companies unlisted, listed or to be listed on the recognized stock exchange in India, units of scheme floated by domestic mutual funds including the Unit Trust of India, whether listed or not listed on the recognized stock exchange, government securities, derivatives, commercial papers, security receipts, Indian depository receipts, investment in shares or convertible debentures of an Indian company engaged in the activities are not permitted like chit fund, agricultural or plantation activities, real estate business, construction of farmhouses or dealing in transfer of development rights. SEBI registered FIIs and its sub-accounts cannot exceed 10% of the paid up capital of Indian company. For high net worth individuals, NRIs and PIOs, this limit is 5%. Purchase is made through a stock exchange or through the designated branch of an authorized dealer, that is a facilitator.
So let's summarize what we have learned regarding this module. In India, there's a free regime for current account transactions, but still partial convertibility for capital account transactions. Many economic experts are of the view that we need full capital account convertibility of currency. Recently, the previous RBI governor, that is Raghuram Rajan, in an interview suggested to move towards full capital account convertibility in the short number of years. So Mr. G. Padmanabhan, Executive Director of the RBI, suggested that India should move towards making the rupee more convertible for capital transactions by foreign investors. According to him, Keeping any restriction for too long could prove self-defying. But he also said that how fast that movement should be would, however, depend upon how fast the country could meet the preconditions like fiscal consolidation, inflation control, low level of NPAs, that is the non-performing assets, low and sustainable current account deficit, strengthening of the financial market, prudential supervisory of the financial institution, etc., which were imposed earlier. Otherwise, it may prove very risky for us. Thank you very much.